Welcome back to Investing with Confidence. I am your host, Joshua David, and we are having a great time in studio talking about financial illiteracy and helping us in America with more financial literacy. Also, don't forget to subscribe to the podcast wherever you listen to podcasts and check out the Investing with Confidence YouTube show. Maybe catch a couple outtakes there.
Oh, no.
Oh, no.
Gosh.
So, Al, as we
You
get...
promised me you're going to get rid of those.
It's...
Okay,
I'm gonna get you one day.
I don't have enough money.
So, as we get into this next topic, Al, we talk a lot about the financial markets, but when we refer to the financial markets, referring to the smart money, and that's the banks,
Right.
the institutions. It's the big money. It's the big institutions that have, in your words, the clout to move the market. They have the money to do that. Now, they are always, and I repeat, they are always creating income using these markets. And they're not only just using the stock market, they're using other markets as well to their benefit. Now, some of these markets, the public have heard about, the average investor, but they really don't know what they are.
Sure.
But also these techniques. The public thinks that buy and hold is the way to go. Over time, that's not a very good strategy because what's the biggest thing that you lose there? It's time.
Right.
So what are some of those different techniques and these different strategies that the smart money is using to create income with all assets?
Yeah, you mentioned that people may have heard of some of these other assets, and typically what they've heard is not good. It's negative, but that's all part of, I think, how we're being conditioned by Wall Street to maybe stay out of those.
That's got to be one of those new C words, is conditioning.
We'll throw that in with our combo of C's.
Yeah.
But why is that the case? Why would they not want you, typically as their client, to be using some of these assets? And the real reason is that these guys are in business. Wall Street is in business for their bottom line, and they want to have a profit as easy as possible. They want to be more efficient with the use of their assets, and their bottom line is to increase the amount of money in their pocket on an annual basis. If they have to spend a lot of time dealing with each individual client, that costs them money, and it's less money or less time for them to go out and garner new assets to manage or supposedly manage, and it also is less time for them to be trading their own assets. So they will put their clients primarily into something that is a long-term hold where they put together a portfolio, and then you're told just to hold on to it for maybe decades before you look at whatever kind of profit might be there. That means that you don't have to worry about drawdowns or bear markets because the market will always come back. And if you hold on to something for decades, you probably will have a profit at the end of that time. But what about the lost opportunities? And why doesn't Wall Street do that? Why doesn't the smart money do that? Because they understand the value of short-term trading. And this is the goal in any trade or investment that you do is to have the best combination of risk and reward for you individually. And for some of you, that might mean doing something other than that long-term type of a portfolio. If you ever have an emergency, and how many of us don't ever have an emergency of some sort that usually costs money? Well, how do you come up with the money to pay for that if you have your money into something that you have to hold on to for another 20 years before you can access it or before you're supposed to access it? So all of us have that need or that desire to have some additional cash for our short-term needs. Whether it's just to have a little bit of extra fun, whether it's to make sure all your bills are paid. And I had a situation here about a week ago. I was eating some fried chicken. Who would think that would hurt you? Well, it broke a tooth. It broke off a tooth, and so I have to have surgery. I have to have a surgery and then a post put in and a crown.
Al, you're not supposed to eat the bone, right?
Oh, is that the problem?
That
might have been that hair. This was not a bone. But anyway, so there's like $5,000 or $6,000 right there. Well, those are things you don't count on, but it's nice if you have a little bit extra cash to be able to cover things like that.
Or the potential.
The potential.
Remember, all these are potentials. Some of the things we're talking about here, with trading and investing, there's no guarantee, but if you have the potential and you increase your odds, I'll let you guys finish that sentence, right?
Yeah, well, that's exactly right. Yeah, nothing is 100%, but you can do things to increase your probabilities. That's what we're talking about. It's increasing the odds, trying to put the probabilities in your favor. But it's that risk reward. But it's for you individually. And the way we approach the markets with education is to teach strategies that are aligned to your individual short-term and long-term financial needs. And Wall Street might tell you, if you go into an advisor, they might say, well, let's look at what your needs are. We'll put together a strategy for you. But basically, everything goes into that long-term strategy. So you may be put into an asset with hundreds or thousands of other people, not specific to you. And then what about managing it to make sure that you have that reward and that your principal is protected? The only person that can really do that on a regular basis is you. And the only person that's going to wake up every morning thinking about you personally and your financial situation is you, not somebody that has 200 or 300 or 400 clients.
You're right. I just want to just clarify something too. When Al's talking about short-term trading, it's not, a lot of people think day trading. The strategies and techniques that our sponsor, Online Trading Academy, teaches, they're designed for whatever you're looking to do or your objective in the market.
Right.
So when he's talking about short-term trading, it's not just day trading. That could be, weekly trading. That could actually be monthly trading for some people. That could be short-term for some people. So these strategies, you define yourself, and then you find that strategy and the different techniques for your plan. And that's the key, is to have that strategy for your plan, not for a basket of hundreds or thousands of other people.
Yeah, it shouldn't be a one-size-fits-all kind of a portfolio.
You're exactly right. The only thing that works on that is baseball hats. Al, we mentioned, the different things that people are looking for, whether it's short-term or long-term. Now, there's other assets than just the stock market.
Right.
Let's dissect those a little bit. Let's talk about, in my opinion, two of the best markets out there for, we'll call it short-term trading, like you're talking about, the futures and forex market.
Right.
What are those?
Yeah, well, let me kind of enter into it by saying this: why are there those different assets, and why do the smart money, or why does the smart money use those assets and those strategies? Well, you play golf, right?
I do.
Okay, let me ask you this: if you were going to play in a tournament, would you rather play against someone who's never played before but bought some really good equipment, or would you rather play against someone who bought some great equipment and who has taken several lessons from and played with the club pro?
Well, I'll tell you one thing, Al. I am that guy that has some nice clubs out there. I try to wear the nice clothes, but I'm not the best golfer. So I want to play against that same person, not the person that has all of the experience.
Yeah, because the great equipment isn't going to help you unless you know how to use it. And if you're teeing off, are you going to use a putter? Are you going to use a driver?
Well, it depends on how many drinks I have, but let's just say I'm going to use a driver.
Well, exactly. So there are different clubs. Where the reason people have a bag full of clubs is because different clubs are used in different situations.
Okay.
Same thing is true in the financial markets.
Makes sense.
Yeah. And so there are strategies and assets you can use for long term. And that is one of the things everybody should do. You should have a long-term portfolio that you can rely on when you go into retirement, because every one of us is eventually going to be there. But if you're looking short term, that's a different club, so to speak. That's futures, that's forex, that's options. Those are leveraged assets. Those are assets that can be used in up-moving markets. They can be used in markets that are going down. Options can be used in a market that's going sideways, where it's trending, where it really doesn't make any difference whether the underlying, because you have to trade options on something, the underlying might be a stock or an ETF. But if that underlying goes up, down, or sideways, there are option strategies that you can have where it doesn't make any difference. So you can be non-directional, so to speak. But those assets can be used in different market conditions. But the big thing, I guess I'd call it the backbone of these assets, is leverage. Yeah. And that leverage really allows you to participate with a smaller amount of money. Basically, you have less money at risk if you know how to do this properly, but you can have a smaller amount of money and control a larger investment. That's one of the reasons that the institutions use it. Futures and forex also trade 24 hours a day, giving you more trading opportunities and a better opportunity to manage your portfolio. because those markets basically never stop.
Yeah, so the futures market, that would be like your commodities, right? A lot of people know what commodities are: gold, oil, silver.
What is that other one?
Lean hogs. We can't go a show without saying that.
Is there no such thing as a fat hog?
Well, I think they all are fat.
Okay, well,
and they taste pretty good.
Yeah, I don't know why they call them lean hogs.
Yeah.
I obviously am not. Did not grow up on a farm.
Yeah, and this is not a cooking show, so we don't got to talk about that. But but also the S&P 500. So people that like to trade stocks, you have the S&P 500, the Dow, the Nasdaq, the Russell, Forex,
foreign markets too.
Yeah, the Forex market would be like your currencies, the dollar, the yen, the Swiss franc. Basically, you're trading one currency against another. So if you're listening now and you've traveled, let's just say to a lot of people have gone to Mexico,
right?
You probably exchanged dollars for pesos,
right? And vice versa when you come back to the U.S.
And that's the same thing as trading and investing in the Forex market. You're trading one currency, the exchange rate, against another.
Yeah,
and that's what's great about these different assets is they allow the average investor to participate globally.
Exactly.
Right.
Yeah. And those markets don't close just because our stock market closes. The markets internationally don't close. They're functioning, and that can also have an impact on our market when it opens the next day. But the great thing about these assets, in addition to leverage, is that you can use them to be properly diversified. Yeah. And Wall Street will tell you that you're protected because we have you diversified. So you've got some stocks or mutual funds that are in the financial area, the growth area, the value area, the technology area, healthcare, consumer staples, all of those things. So you're well diversified, but they're all part of one market. And that market, the correlation becomes very strong when the market is correcting or crashing. In futures, for example, if you look at any of the commodities like lean hogs, for example, lean hogs and the S&P 500 have no correlation. So there are things that are not correlated. There are things that are correlated. There are things that are inverse correlated. That's true diversification.
Yeah, and think of, this is a golf theme today, the way it sounds. Think of if you're in all stocks in your investment portfolio, think of that as your golf bag. Now, if you hit a couple balls in the water, what does most people do? They throw their clubs into the water. Think of that whole bag going into the water because they're so upset. That's the kind of the myth of being diversified. As people think you have to be in all these different stocks, they're all the same asset. So, Al, you talk a lot about diversification, the 24-hour markets. Think about this. If you have the opportunity to trade in the evening, most people work during the day. That's another opportunity. Al, coming up next, we have a lot of listeners that want to understand more techniques and strategies about retirement accounts. We talk about being diversified. That's the key in retirement accounts, so you don't have that one big loser. So coming up next, retirement accounts and opportunities in them. This is Josh and Al. We will be right back.